Hello guys and welcome back to the channel. So today I want to talk to you about a serious topic, a huge Palantir mistake, and this is actually a mistake that you can make on any stock, and I don't feel that this gets enough attention or enough of us actually understand it. Even I get new understanding of this on this theory every day, and I really want to share it with you. It's super important if you're a Palantir investor, so let's go. And as always, please make sure you hit the subscribe button. And if you want to go further, you can check out the first link in the description box below, where you can support the channel on Patreon for $5 a month and get direct access to me and all the valuations that I show in the videos and my eternal gratitude. And actually today, some guy made my day because he became the first patron of this channel, and I was a bit down and I saw that he joined Patreon and really made my day. So thank you so much, Greg Schaffner. I hope I didn't butcher your name. So here's a shout out. If you're interested in becoming a Patreon, then check out the link below. So here we go, guys. So here are some things that nobody talks about, and this is a bit controversial. So the first one of them is it doesn't matter where Palantir's price goes, and it doesn't matter if you save a few cents or not. So many people have so much attention on if the stock is $6.50 and if it's $8.05, they're not buying. But if it's, below $8 and it's $7.51, then it's a good deal. And it's actually not important. And this goes for so many other stocks that you're interested in investing in. And actually, you shouldn't even be focusing on the stock price. You should be focusing on your income. And I promise this will make a lot of sense as we go on. So you cannot time the market bottom. I used to be a technical trader, and it's a game of mathematics, and it just doesn't work. I can tell you from experience, nobody can time the market. And even if you get occasional gains here and there, in the long term, you will lose out money. And actually, there's another YouTuber called Sasha Yanchin that I follow and I like, and he did a very good video about this. And I just want to show you a speeded up 2-minute clip, but I'm going to post his full video in the description box below. It's a super good video to watch if you're a long-term investor, but I just want to show you a quick part of it.
Hey guys, it's Sasha. During a market crash like the one we're in right now, you will hear a lot of people telling you that you can make a lot of money by perfectly timing the market, selling out at exactly the right moment and then buying back in when the stocks have gone down. One YouTuber after another will be telling you that they know when the bottom is going to be. You should not invest because only idiots will invest when the whole market is going down. You are just going to catch a falling knife. It is much, much, much better to wait and then invest at the very bottom, and you will make a huge amount of money as a result. The big problem with this theory is that it is complete rubbish. And unlike the proponents of drawing random lines on charts, pretending that those random lines mean anything whatsoever, I actually have data that I'm going to share with you. Numbers do not lie, and let me show you why dollar cost averaging through the downturn absolutely destroys timing the market over the long term. It is not even close. First, let's talk about investing during an actual market crash. I will show you how much money you can lose trying to time the market when the market doesn't end up crashing a little bit later. So let's use a popular recent example of the dot-com bubble. Let's assume that you are an investor in your 20s or 30s, and let's say you started investing a few years ago and you have, say, $20,000 in your portfolio. And let's say you are financially astute and you are able to put $1,000 per month into your investing account every single month. This is just an example. I know everyone's personal numbers and circumstances are going to be different. So let's say you are looking at this person in August 2000, just before the stock market began collapsing. And then let's say that that person just goes and puts in their $1,000 into the stock market every single month, come rain or shine, and they just buy the S&P 500 because they are boring and ridiculously sensible. I
really want to go back here to show you this graph of what it means to actually be buying a stock that you believe in. Look at how often, this is once every month. Just when you're doing this, the price absolutely doesn't matter, and it gives you a whole different perspective. And this is over a year of 3 or 4 years.
Boring and ridiculously sensible. They invest in September 2000, in October 2000, in November 2000. They don't care if the market is going up, going down, going sideways, whatever. They just keep putting money in every single month. And let's look at the 4-year window through to July 2004. That roughly covers the crash and then the initial bit of the recovery. If you kept feeding your money in every single month over that period, you would have invested $68,000 during that time frame, including the original $20,000 that you already had. And if you were buying the S&P 500 index with your money once a month using the numbers from this chart, assuming that the original 20,000 bought at the very peak, you would have 35.5 units of the S&P 500 index at the end. These would be worth $60,352 because in July 2004, you were still at a much lower point than when you started, so you would be down $7,600 on your investments because of the market crash. So about 11% down.
It would make the video too long to watch this whole thing. I really highly recommend that you watch this whole video. It really gives you very nice viewpoints. First of all, what I want you to see in here is how protected you are if you follow this theory. After the dot-com bubble and a huge crash in the S&P 500, because you're buying every month and not looking at the price, you would be only 11% down. And then when the things go on the up, you will look like a genius for buying. He will show the math behind it. And the reason why I show his video is because I can't do a better video. So I don't want to waste your time or my time. So it's just better to watch his video on this. So because you cannot time the bottom, you have to focus on the only thing that you can control. And what is the only thing that you can control? That's your income, your income, your income, your income. The only thing that matters is your income. So focus 5% of your attention on how you cut your costs, because yeah, that's one way to, have investable money. But trust me, you cannot save yourself into becoming a millionaire. You actually have to make money. So 95% of your attention should be on how you can increase your income. And here's some very easy ways. You need to negotiate for a higher pay at your job. You need to work extra. You can, take an extra job, you can save money. But again, this is not so important. The majority of the people that I speak to cannot save money because they're earning so little. Even if you're earning, $50,000, $60,000 a year and you have a family, trust me, you cannot save money. If you have kids, you have to increase your income. So think with that instead. I want to show you something why this is important. This is also on my Patreon. And this is a table of how you can make $1 million. And again, I know that this is kind of boring and kind of simple, but trust me, so many people don't do the math. And this is why they're not going anywhere in life. So let's say that you have a family income, take home $50,000 and your family spends $50,000. So you have zero money left over to invest. But from somewhere you had $10,000 to invest and you want to get to $1 million, right? So there's two things that you can control. One is your return, which you can't really control. I will come back to this, and your income, right? So, but in this, just for example sake, so here you don't have income to invest. So now your only thing left is you have to get very high returns on the market. So for you to make it to $1 million in 12 years from now, you would have to get a compounded annual return of 50%. If you would do that, you would become a better investor than Warren Buffett. You would become a better investor than Peter Lynch, all the other guys that you know there. And I pretty much guarantee you that it's not going to happen. Okay. So even if you get a 20% return, you are way outproducing the S&P 500. You're outproducing, the portfolio managers, and it's a fantastic return. And look, if you are not adding to the money that is invested in 14 years, you're only at $128,000, even with majorly outproducing the S&P 500 and most of the money managers. So let's be real, this is also probably not going to happen. So if we go with that, you would only invest into the S&P 500, so you're not controlling the return, but instead you change your income. So maybe you take an extra job, maybe you negotiate a higher pay, maybe you take a training, use your fantasy, maybe you start selling better and your income goes to 80,000. And now with a very, very shitty return, okay, you shouldn't say shitty return, but most of us want to make more than 10% per year. So now you immediately basically become a millionaire after 14 years, even with this very low and realistic number that you can do basically by just investing into the S&P 500. But what if you increase your pay even more? Because, you can. It's actually, I think, easier to increase your pay than to become better than Warren Buffett. Trust me on this. So if you could increase your pay to $120,000 a year and keep your family spending at $50,000 a year, then within 9 years, you become a millionaire. Play with this if you want to. And I think you should, because honestly, so many people don't do the math. And it's way more important how much you set aside to invest than the returns that you're getting on the money. And so many people don't think with this, and they forget about this. Okay, so back to how this relates to Palantir. So if you have a time horizon and a valuation on Palantir, so I really recommend that you don't follow other people's valuations. My time horizon is 10 years. I like to buy stocks where I don't have to think about what happens with the stock. I can put it in a shelf and then I don't have to think about it. And the reason why it is like that is because I have this YouTube channel to run, and this is not even my main job. My main job, I'm a real estate developer in South Sweden, and we're building hundreds and hundreds of apartments. And I cannot take attention away from that to, you know, go from 10% return to 12% return. You know, I get way more ROI on focusing on my businesses and on the YouTube channel, and, you know, having more money to invest. And this is, I guarantee you, 99% of the people, unless you're born with, you know, having a hedge fund behind you and your dad just gives you a hedge fund, it is also the case with you. You are way better off focusing on your income and, you know, buying stocks that you don't have to think about on the long term, and, you know, just repeat. You know, it's really boring, but really, really effective. So now, if you are this type of investor, so this only works if you're into this in the long run. So I am upset every time Palantir goes up, because I want the stock price to be as low as possible for a very, very long time, so I can accumulate a very big volume of shares. So I am not focusing on the price of the shares, and I'm not spending my time on this. What I'm spending my time on is actually earning income to have investable income. And I don't really care if I'm buying Palantir for $7 or $8 or $9. But what I do care about is when the stock market actually starts reflecting the real value of Palantir and the stock goes to $100, $150. What I care about is, do I have 1,000 shares that I very proudly bought at the lowest possible price of $6.44, or do I have 100,000 shares with a cost basis of $10,000 when the stock goes over 100? It's really something to think about for everyone. Again, I have my Palantir valuation that is here. I really recommend that you do your own and don't listen to anyone's. This is available on the Patreon, and, you know, you can play with the numbers to see if you think the same as me. But the point is, I like to target a 30% return, even though I said that this is very hard. And I, you know, maybe it doesn't work, but I still like to, you know, aim for very high things. And if it only becomes 15%, I'm still very happy with it. But I like to have, you know, shoot for the moon, as they say. And in my calculations, as long as the stock is below 9.34, I'm very happy and the stock is a buy, right? And if the stock is, you know, $6 or $7, I don't care. I am going for the volume. So focus on your income, guys, and invest as much as you can for as an extended period of time as you can within your price target. Thank you so much for watching, and I will see you in the next video. Bye-bye.